All right, let's get straight to it. That monster surge you saw in the KOSPI tonight, it's not what you think. This is a classic localized trap, not some global risk-on signal. It's all been driven by something called a position vacuum, and frankly, it's about to run headfirst into a brick wall of US macro data. So let's break down exactly what that means for our game plan.
So let's start with the central puzzle of the day. We've got this huge headline-making jump in the index. But at the same time, the smart money, it was doing the exact opposite.
Okay, here's the number that's got everyone talking. A massive plus 8.44%. I mean, this was an explosive move. It didn't just climb the ladder, it took a rocket ship straight to the top. And if you're just looking at the surface, yeah, it looks like a huge green light flashing from Asia. But hold on, this is the number that really matters. While that index was screaming higher, global capital was bolting for the door. We're talking a net sell of 612 billion won. You just don't see that kind of split. It's a major red flag. So that leads us to the big question, right? How in the world does the price go parabolic when the fuel, the actual capital, is draining out of the tank? Let's get into the mechanics of what's really going on here. The answer, and this is the key to the whole thing, is a market condition I call the position vacuum. This concept explains everything we saw today. So what is it? Think of it this way. The market was totally unprepared. Everyone was leaning the wrong way, super defensive and way underweight. Then, a positive catalyst hits and bam, a frantic forced buying panic kicks in. It's a mad dash to get back in, and price just skyrockets way ahead of any real new money coming into the market. This visual right here nails the concept perfectly. It looks like a huge explosion of buying power, but it's happening inside a hollow shell. The price isn't surging because of a tidal wave of new investment. No, it's jumping because there's nobody on the other side of the trade. The order book is thin. There are no sellers, so any buy order sends it flying.
So how did we get here? It's basically a three-step process. First, you had all this recent volatility, which made everyone de-risk and pulled liquidity out of the market. The order books got thin. Then, step two, the trigger. Some piece of news hits, and suddenly institutional managers are way behind their benchmarks. They have to chase or they lose their jobs. And that leads to step three. That desperate catch-up buying slams into a super thin market, causing this ridiculous outsized price jump. It's a chain reaction.
Okay, so that's the theory. Now let's look at the hard data, because the numbers don't lie, they tell this exact story. You want to know where the entire move came from? It was basically two names, the two heavyweights of the Korean market, Samsung and SK Hynix. They did all the heavy lifting for the entire index.
And this table, well, this is the smoking gun. Just look at it. Samsung ripping up over 13%. Hynix up more than 10%. But look at the foreign flow column, net sell and net sell. Global capital was selling into the rally. This proves it wasn't new demand. This was a textbook short squeeze, a localized structural event.
So the key takeaway here is simple, but absolutely critical. What we saw was a positioning-driven move. It was a mechanical reaction inside the market, not a sign of new global demand for these assets. The evidence is just undeniable.
All right, and that brings us right to the US Open. We've established the signal out of Asia was a fluke, a structural anomaly. Now it has to survive a major test, a lineup of some heavy-hitting US macro data.
And here are the upcoming data points that matter. We've got ADP private payrolls at 8:15 EST. That's our first look at the labor market. Then the ISM manufacturing PMI at 10, a huge gauge of economic health. These numbers are going to move the bond market, they're going to move the dollar, and they are going to decide whether this rally has legs or if the trap gets sprung. So when it comes down to it, there are only two ways this can play out tonight. Path one is the bull case. The US data comes in soft, the market thinks Fed easing, and the Nasdaq holds its key pivot. That would actually validate the move we saw in Asia. But then there's path two, the bear case, the trap. The data comes in hot, the dollar and yield spike, and the Nasdaq breaks key support. If that happens, the KOSPI surge is exposed for exactly what it was, a fake out. Analysis is over. Time for execution. This is the battle plan. Directive is clear. Do not trade the headline, trade the supply chain. Focus on one number only, 24,000. This is the pivot for NASDAQ 100 futures. This is the line in the sand. Target asset is NASDAQ 100 futures. Watch the 24,000 pivot. If it holds, post data, upside target is 24,400.
If it breaks, downside support is 23,700.
Your decision framework is simple. Enter on a break above 24,000 after the data. Exit on a break below 23,700. And validate the long trade if US 10-year yields spike on hot data.
This signal out of Asia was a structural anomaly. The question now is simple. Will US data confirm the trap, or will it fuel the fire? The data will decide. Get the analysis you need before the US Open. Make sure you're subscribed.